What's up, this is Mandalo, and in this video I'm going to talk about how to identify ledges in market profile and look for trade setup around these areas. When ledges form in TPO profiles, they can be interpreted as visual representation of a level tested multiple times in a session. And this allows us to easily identify areas of support and resistance. A ledge is at least 2 TPOs greater than above or below rows, often with a steep drop off above or below them. This way of looking at market structure can smooth out some of the noise from wicks and allow us to see the bigger picture. Though TPO isn't necessary to find areas of support and resistance, it can make it easier to identify them within a session. This helps us focus not only on the highs or lows, but also lower time frame highs or lows of importance. This can provide more opportunities for trade setups to target. The more TPOs within a ledge shows price traded at that level more periods within a session, and in many cases that level was tested and rejected more times. This suggests an area is a strong level during that session, even if it isn't at the session highs or lows. Ledges often form when price action is range bound and especially are common during weekends. Ledges can present intraday setups and are usually broken more frequently than poor highs or lows since they form within the profile and not at the extremes. As the market is tested a level multiple times without breaking it, this often builds liquidity. Breakout traders look to trade up break of the zone, and other traders place stop losses around these levels. This is a common reason extended consolidation can form a tight range, and ledges might even form on both sides of that range. Fresh positions are opening betting on movement outside the range, and when price action moves against them, these positions will quickly close. Sometimes a break of the level can lead to cascading stop losses and liquidations. More often though, breaking them with acceptance beyond the level can lead to support resistance flips, and retesting can lead to continuation away from the level. If the level a ledge forms is broken and price begins to accept beyond it, it may be back tested in a bullish or bearish retest before continuation for a larger move. Since these levels represent support or resistance during a session, flipping resistance into support is bullish, or support to resistance is bearish. Even though these features form within the profile of one session, they represent significant levels for area price tested multiple times within that session. So even after a session concludes, these levels can be important as price tested them during multiple periods. And price action of later sessions may also respond to these levels, especially if they remain unbroken, or these areas may be somewhere to anticipate a retest if price pulls back. In my opinion, it's a super useful structure for trading weekends or range-bound conditions in lower time frame, but we can also apply them to higher time frame. In this session, we had a ledge form where the level was tested multiple times with a swing failure, back to support at the bottom end of the ledge. And in the following session, support was tested again. Resistance at the upper ledge was tested, broken, retested as support, and continued beyond the level. Again, we had ledges form on both sides of a range. Price consolidated, lost the level, reclaimed it, broke the ledge to the top side with a retest, dumped all the way back to support, swing failed the low, reclaimed the lower ledge, and continued higher. In this consolidation, we traded the tight range, lost the lower bound and reclaimed, broke the upper ledge, lost again, retested the lower ledge as support before breaking out and clearing poor highs, falling back inside the consolidation zone and bearishly retested the upper ledge resistance, led to a test of the lows of the consolidation where liquidity was lying under the weak lows, and we cascaded away without a bearish retest from the underside. With the recent consolidation we've been mostly focused on in this video, there was a strong level which produced a bounce, and when we lost the level, this area, which had been support, became resistance. The important question to ask or to consider is whether that previous support has been reclaimed or if it is now resistance. Trading consolidations can be tricky especially on weekends when low volume makes it difficult to determine the direction that price may break. Placing orders either above or below a level during a consolidation can be risky. Often before leaving a range, both sides of a consolidation are often tested before the real move occurs. Instead, it's much better to wait for a break and react to the price action with additional information such as order flow before placing orders to enter a trade. In this setup, a break of the ledge and retest of the upper ledge, you would be looking for higher, especially without the sweep of the upper level. Targets for this trade would first be a sweep of the local high, then the weak highs, naked point of control, and value area high above, and then leaving some to run with stops below the lower ledge. Consolidation above the upper ledge suggests it is becoming support, and even with a quick grab back within, especially with a tap of the point of control, would be a nice area for a long. Again, stops resting below. Dipping below the ledge, swing failing the local lows, and reclaiming would be a nice bullish reaction with targets at the local high, along with some of the other higher levels. Somewhere I would not be looking for a trade or may flip my bias would be a loss of the level regardless of taking the local highs and retesting from the underside and rejecting. In this scenario, I would be looking at some of the lower identified levels, such as the point of control and the weak lows below. These are risks that you run entering blindly, especially on weekends. Areas which may suggest a little more of a bearish reaction outside the range would be a sweep of the local highs, especially with a retest. Taking a trade above the range, while it may have a good risk to reward, you run the risk of a bullish retest on the top of the range and continuation higher. But accepting back into the range, especially retesting the upper boundary, would increase probability of the trade going to target. With the topside liquidity tested and failure, loss of the range is a bearish reaction, and lower levels are now a consideration. Areas to identify within this chart would be the lower untapped naked point of control and the weak lows resting below. Looking to short a breakdown of the level, even with a bearish retest, consider areas which may produce a bounce, especially with the untapped highs. It's important to consider other information that's simply a feature within the market profile. Zooming out can also be helpful for context with respect to the reason an area may be support or resistance in the first place. This level is a high volume node, as well as the high of the February pump when we first entered the range. Over the past few months, it has been tested as support or resistance. It shouldn't be a surprise that price has stalled in this area for consolidation, for this indecision point in the market to help determine the direction that price will go. So even though extending the level seems like a tight range around our daily ledge, it in fact was extremely important. So what happened with our trade setup? Well, our small ledge was lost. Naked point of control below was taken. We had a bearish retest from the underside of the level. Weak lows were lost, and continuation for quite a significant move occurred. Experience observing ledges can be helpful to expand potential intraday trade opportunities. Thanks for watching. Please like and subscribe and share if you think it's helpful. Good luck, and see you in the next one.